Hi, I've worked on this video quite a bit. There's really good content in here. This is the result of 1000 backtestings. I've backtested 1000 trading strategies. This is Ethereum here in white. And what you see in green is the result of the backtest. So the performance you can expect by following this exact trading strategy. So this is a more technical video. There's quite a bit of numbers involved, quite a few charts. But I'm pretty sure if you take the time to get through all the content from beginning to end of this video, you'll probably get a lot of value out of this. So if you enjoy this kind of content, feel free to leave a like as well. So let's jump in. The way the trading strategy works is by following a simple moving average. So you're probably familiar with moving averages. The way they work is at a certain point in time, they average out the price movements that came prior to that. So a point over here on this blue line is the average of the prices that came before that up to a certain time period. So what the indicator tries to do is to find the general momentum, the general market sentiment. If it's going down, prices tend to go down. If the indicator is going up, prices tend to go up. So it tries to eliminate these fluctuations that happen all the time, tries to reduce the noise and figure out the general direction where the market is going. And the trading strategy is pretty straightforward. So in white, you've got the Ethereum price. In blue, you've got the moving average. And in green here, we've got the portfolio line. And the idea is that we exit the market whenever the price is below the moving average. So our portfolio line is completely flat. And we enter the market whenever the price is above the moving average. So we follow the price movements. And so the idea of the strategy in the end is to avoid those really large losses, right? But on the other hand, to still be in the market when times are bullish. Now, I've done a similar video on this a while back, which was backtesting the daily prices. And with that backtest, the link is in the video description, we found out that the best moving averages for Ethereum on a daily time frame are the 23 and the 39-day moving average. So whenever I look at the Ethereum chart, at the daily price chart, I look at those two moving averages, the 39-day moving average here in dark blue and the 23-day moving average here in light blue. So according to those moving averages, we are now bullish and we should continue to rise because it's a trend following strategy. But this video is not about that. This video is about the hourly moving average. So if you're more of an active trader, can you use the hourly moving averages? And if yes, how do trading fees actually come into this, right? Because when you buy and sell on Binance, for example, you've got a fee of 0.1% for each trade that you make. Now, when you trade hundreds of times, this adds up, right? These fees, they add up. And so they need to be considered in such a strategy. And I have done all those backtests, including the trading fees. So the question with such a strategy is, what's the best moving average to take, right? Because when you've got now the hourly moving average, you can take any kind of duration, right? And the longer we go with that duration, the further we go away from the price. And as per tendency, we also have less trading signals, right? If we increase the length here, we have way less trading signals. If we have a very short duration, we've got more trading signals. And the question is, what's the best balance here? Because you really want to exit the market quickly when it goes down, but you also don't want to always trade in and out and get a lot of fees with that. So the backtest is to find out what's the perfect moving average for a trading strategy to exit whenever the price is below and to enter whenever the price is above the moving average. Now, the reason why the strategy works in general, or why it should work, is because we avoid the big crashes, right? When it turns bearish, we are not in the market. That's why it really works. Because when we look at just this very short time frame over here, we're actually not really gaining that much more money when prices tend to rise. But the way the strategy outperforms is by not being in the market when prices crash. Then we are just simply in cash. And so this is really not a profit-making strategy. This is really a loss avoidance strategy. So let's look at exactly that. How much loss do we actually avoid by doing this? And when we look at the very long-term chart, so this is now 1.5 years of trading data, we can see in white, this is Ethereum, that the price can drop quite a bit, right? From a top over here to the bottom, we had quite a drop. Here in percentage terms, we also had quite a bit of a drop. Not that visible because this is not a logarithmic chart, but in percent it was quite significant. For Ethereum, for buying and holding from top to bottom, Ethereum fell by 66%. So this was the maximum drawdown from the top of Ethereum's price to the bottom that came afterwards, right? From the top to the bottom, 66%. Now, what is this green line over here? This is the result of 1,000 backtests. What you see over here is the duration of the moving average measured in hours. So over here, we've got the 48-hour moving average. Over here, we've got the 96-hour moving average, etc. And each of those dots on the line is a result of the backtest. Now, this point over here means that for the 480-hour moving average, if we trade it according to that moving average, then the maximum drawdown from the top of the portfolio line to the bottom would have been around 55%, something like this. So this green line here would have dropped 55%. Now what this also means is that when we trade according to this moving average over here, the maximum drawdown from top to bottom is way less. In fact, it's 19%. That's for the 89-hour moving average. So if you do the strategy of getting in the market and out of the market, your overall risk is way less, right? You buy and hold Ethereum, you might lose 2/3 of your money temporarily. You trade according to those moving averages, you might only lose 19%. Now, why is that important? Because you could, in theory, I've not backtested that, but you could, in theory, use this to your advantage, right? You could, in theory, say leverage by a factor of 3, get the same kind of risk exposure, theoretically speaking, but then potentially make way more money. If you don't use leverage, though, then this is still interesting, right? Because you can just sleep way better. You've got way less risk exposure. Now, what's also interesting here is that no matter what moving average we take here, we will always lose less from the top to the bottom compared to buying and holding. Buying and holding is minus 66%. No matter what trading strategy we use, we potentially lose less. So it doesn't really matter what moving average we use if we want to reduce risk. Now here's the problem, right? This is only looking at risk. This is not yet looking at return. And that's in the end why we are in crypto. We want to make return. And here we've got the backtesting results for the return. So if you bought and held Ethereum in that time period, the 14th of February last year to today, you would have gotten 368% per annum. And that's now the white line over here. That's what you would have gotten just by buying and holding. Now, what's also interesting is that there's quite a few moving averages here that underperform buying and holding. So you do get less risk, you do get less of a drawdown from top to bottom, but you also get less performance. And that's obviously not what we want, right? We want to at least match the performance. Reducing the risk is a nice bonus, but we definitely want to match the performance, right? And we can get this with a few moving averages, but not with all of them. We have to be picky. Now let's dive into the details here. What's that moving average over here? You probably want to know. That's the 91-hour moving average. So that would have given us 627%. Now that's interesting, right? Because this gives us a lot of performance at the same time quite little risk, right? So we might take the 89-hour moving average, we might take the 91-hour moving average, maybe just the middle, the 90-hour moving average. But that's the result, right? We seem to not have to make the trade-off here. We can get a lot of performance while also having quite not a lot of risk. Now let's look at the other results here, right? This is 1,000 backtesting results, so we want to see the rest. Over here, this very short-term moving average that's still better than buying and holding is the 17-hour moving average. It still would have outperformed buying and holding. It's this point over here, but it's obviously nowhere as good as the 91-hour. Now here we've got both moving averages plotted on a chart of Ethereum. So the 91-hour moving average here in blue, and in red we've got the 17-hour moving average. So the backtesting only looks at hourly close data. It doesn't look at how is the price moving within the hour. And so we can see here for the very fast 17-hour moving average, it would have told us to sell over here and then to buy over here again, a bit of trading noise over here, and then we would enter again, quick exit, quick enter, and then we are off to the races and going up. And we can see that the slower of the two moving averages it creates way less trading signals, but it obviously also avoids losses a bit less, right? So here we would have sold already at 3,600, and with the slower of the two moving averages, we sell later. Now let's look at others. This here is the 684-hour moving average, still working relatively fine. That's the white line over here. So we can see this is a very slow moving average, but the backtesting says it works comparatively well. So we would have exited the market over here. We would have avoided a 7% loss and then be in the market again. A few failed signals over here and then again saved ourselves from a slight drop. That's how it works, right? It really is a loss avoidance strategy. Now let's also look at what does not work well. That's the 253-hour moving average. It would have performed way worse than just buying and holding. And I think this is interesting. Maybe we can use this as well, maybe for trend reversals by looking at how far are we away from this moving average. So I will look at this in another video, but this is also one way we could trade this. If this moving average works so badly, if it tells us to go in the market when the prices are not tending to move up, and vice versa, then maybe we can do the exact opposite and simply look at the price. And if the price is very, very high above the moving average, maybe we just simply want to sell. So this could be a nice counter indicator. Now, what you might have noticed about this chart is this title over here. This is the annual return without fees. And this is a message in this video that I really want to drive home. Trading fees, they are very important. I hear this all the time. Binance only charges 0.1% for each trade. You can neglect them. It doesn't really matter. Crypto moves that much up and down that the gains, they definitely outweigh any kind of fees. But that's not necessarily true if you're very active, if you're using very short-term moving averages. And so let's look at this exact same chart at the performance relative to buying and holding when we do include a 0.1% trading fee for each buying and for each selling. And that's the result. This does not look as promising anymore. Buying and holding outperformed almost all of the moving averages, except the averages over here, the best of them being the 91-hour moving average with an annualized return of 409%. So that's pretty bad, right? Once you include trading fees, a lot of the benefit of that strategy goes out of the window. Without trading fees, we've got quite a few moving averages that outperform. Here, like all the way from 50 to say 150 hours, and then again here in the 650-hour mark. So all of them outperformed. But with trading fees, those don't outperform anymore. And we've got just a very small sliver of hourly moving averages that actually do outperform. But that doesn't mean that this whole trading strategy is worthless. But still, I want to show here the difference between those two. If we are less active in trading, if we take very long duration moving averages, then the difference between including fees and not including fees is relatively minor. If we, however, trade very actively, the difference here is very significant. And that's a problem, right? Because what that means is if you trade short term, you have to be very certain about your assessment. And very often the exact opposite is the case, right? We are all relatively sure about Bitcoin being higher than it is today in like 4, 5, 6 years. But we are not so sure about this if Bitcoin is higher or lower, say the next week or the next 2 weeks. There's much more volatility, there's much more fluctuation happening here. And at the same time, trading fees, they do add up and they work against us as well. We are less certain about the future and we also get charged for this way more often, right? Say you do only one trade per day, say one buy order and one sell order. So let's say 2 trades per day and you do this every day for a month, you've got 60 orders. So how much do you lose in trading fees? 0.1% to the power of 60 is a loss of 6%. So you've already lost 6% in 1 month if you do one buy and one sell order per day. Now let's say you do this for a whole year. Now you have halved your money. So you need to have an expected value of your trades to at least outperform buying and holding by 2x to simply be break even. And that's with trading fees of 0.1%. So this obviously does matter. But not all is lost over here. Because let's not forget, the performances here, the after trading fee performances, they are similar to buying and holding for these certain points. Here for the 91-hour moving average trading strategy, it's even a bit higher. So the performances, they can be similar. The risk, though, is consistently lower. Now, maybe one quick recap. Why is actually the risk lower for all of those trading strategies comparing to buying and holding? That's because we are sometimes outside of the market, right? We are sometimes in cash. And if you're only, say, 50% of the time in the market and the other 50% of the time outside of the market, naturally, even if you just simply roll a dice, naturally, you should have less risk. It's kind of like only investing 50% of your money, right? If you're only 50% of the time in the market, or if you only invest 50% of your capital in the market, it's more or less the same thing in terms of risk. So by not being invested all the time, by being outside of the market maybe half of the time, you naturally expose yourself to less risk. And that's why all of those trading strategies, they have less of a maximum drawdown from top to bottom of the portfolio line compared to simply buying and holding Ethereum. So we've got less risk, but in some cases we've got the same performance or even slightly better performance. So even after trading fees, the risk to reward ratio can actually be better. Now, the classic approach of figuring out this risk to reward is with the Sharpe ratio. So that's the classical finance definition. You take your expected annual return and you divide this by the annualized volatility. Okay, so you can measure volatility by checking out how much is the price fluctuating over time. But I feel this is not really very tangible, right? I think this other approach that we have over here, this maximum drawdown approach, how much can we potentially lose from the top to the bottom of our portfolio line, I feel this is more approachable as a measure of risk. Because if you tell somebody, oh, in the past this asset, it was dropping 90%, that's way more tangible than saying, oh, this asset has a 50% volatility. And so let's, instead of using the Sharpe ratio, let's do something slightly different. Let's look at the return per annum that we get and divide this by the maximum drawdown using that trading strategy. And so first of all, let's do this for buying and holding. This is now again without fees. Buying and holding gives us this modified Sharpe ratio of 5.6. So what does that mean? We get 368% per annum. And we have a maximum drawdown of 66%. So 368 divided by 66 is 5.6. So that's the benchmark for our reward divided by the risk for buying and holding Ethereum in that time period. And now these are the results without trading fees, best being the 91-hour moving average. No surprise here, right? It gave the best return. It also gave very little drawdown. So a much better risk versus reward. But what's also interesting is that for most of these strategies, for most moving averages, we did get a better risk to reward. We have our outliers here, the very, very short term for like the first few hours, maybe 10 hours or so. And we've got a valley over here at around 10 days, 240 hours. And here at 20 days, 480 hours. But for all the rest, the risk versus reward following this strategy is better, at least if you don't look at any trading fees. So this already means that those indicators, they do seem to have a certain value, right? This is not just complete random noise. It looks like, statistically speaking, when we backtest this, that most of the time we do make the right bet by following moving averages. Now this is the result when we include trading fees. And of course, it doesn't look as great. But again, we've got our spike at the 91-hour moving average, almost 4 times better than buying and holding if we divide reward versus risk. But what's also interesting is that once we cross, say, the 550-hour moving average, anything above that tends to be better than buying and holding. So this seems to be the cutoff when momentum kicks in. Once we look at timeframes that are long enough, that are at least 550 hours, which is, by the way, 23 days, then we seem to have something positive going on. And that's very interesting, right? If we look at the results for the daily moving averages, we found the best one to be the 23-day moving average. If we look at the hourly moving averages, we can see that starting from the 23-day moving average or the 550-hour moving average, that we do see momentum, that we do see above average performance, better performance than just buying and holding for the risk versus reward. Now this point over here is the 664-hour moving average. So it gives us approximately 2 times the risk versus reward. This does not mean that the 664-hour moving average outperforms buying and holding. In fact, it doesn't, right? If you look at this point here in the chart, this is the performance after trading fees. So it's below buying and holding. But the reason why it's very high on this chart over here is because the maximum drawdown of the 664-day moving average, the maximum drawdown of that strategy is relatively low as well. And so reward versus risk is pretty good for that moving average. Now there's a second moving average that also tends to work pretty well, and that's the 987-hour moving average. So that's this point over here. So again, for completeness sake, the return divided by the downside risk, both without trading fees and with trading fees, for all of those moving averages. Now, what are the learnings from all of this? First of all, don't trade too actively and really watch your trading fees, because it does tend to go pretty badly. The longer your time horizon, the safer you are. Second, it is very much possible to outperform buying and holding, at least in terms of risk versus reward. And if you do want to get more performance, you can still lever this up, but have a proper strategy here so that you don't overtrade and lose everything simply by trading all the time, but also don't expect too much, right? It's not certain that prices will exactly move in the same patterns they have in the past. And so a moving average that used to work might not work as well in the future, even though it's probably the best bet that we currently have. Now, what I also find interesting about those results is for the hourly charts, for the hourly moving averages, we only had a few peaks that outperformed buying and holding. And this is almost expected because we are not in the market all the time. We are only in the market, say, 50% of the time. But still, we don't have outperformance very often. Not for a lot of those 1,000 different moving averages. If we compare this, however, with the daily moving averages, the result was very much different. This did not include trading fees, but here buying and holding would have given us 56%. So this is a longer time frame because we have daily data. This was several years of time frame. For the hourly backtest, I only had 1.5 years. And we can see here that most of those moving averages, without trading fees, they would have outperformed buying and holding, right? Buying and holding was only 56% per annum. Okay, the 2-day moving average didn't work too well, but all those other daily moving averages, they outperformed. And here the trading fees, they are not that high either, right? Because here we are only looking at daily data. We are maximum trading once per day, but we probably only trade, depending on the length, maybe every 2 weeks, every 3 weeks, something like that. So the fees here are way lower. They're also not that important for this backtest, and we get outperformance compared to buying and holding. Once we switch to the hourly moving averages, this outperformance is not that clear. I would have hoped for this green line to be way more above this white line over here. But there's quite a bit of underperformance. So the hourly moving average can't really distill the negative from the positive momentum as well. And so you tend to be outside of the market, even though the prices, they might rise again. So this is another indication that going too short on the time frame is potentially dangerous. The 91-hour moving average might work somewhat, but even then, after fees, we might only hit the buying and holding performance. But probably the best thing to do is really to look at 23 days and beyond. That's where we get the best risk versus reward, even after fees. That's also where we tend to see on the daily time frame the real outperformance. Even if you look at different time frames, right? This was a very different time set compared to this over here. So there seems to be some kind of continuous structure in the data, which is good. But the way I look at this is, if you want to use the 91-hour moving average, probably just use this as an additional tool. Because Ethereum is pretty highly correlated to, for example, a lot of altcoins. And so what you can do is, if you are an active altcoin trader and you do like your altcoin research, where you short-term buy in and out, where you've got more price movements, where maybe the trading fees, they are not as relevant because your volatility is higher compared to your fee for every trade. If you're doing something like this, you might use the 91-hour moving average to kind of gauge, do you want to trade in altcoins or not? But simply using this to trade in and out of Ethereum, it gives the better risk versus reward. And in theory, you could lever this up, but in leverage products, you also have quite a lot of hidden fees. The internal financing baked into those levered products, it is pretty high. It's pretty costly, actually. I've once done a calculation on similar products for stocks. There you had like internal financing of around 13% per annum. So that was quite a while back for equity-linked certificates that were based on the broad index. So I'm not even sure if you would lever this up, if you could really improve your performance by that much. My personal result from this is I will look at this moving average in the future when trading altcoins, but I will still very much focus on the daily moving averages, the 23-day and the 39-day moving average, because it looks like this strategy, it works better on the daily time frame. And so that's what I'm also going to use in the future. I hope you enjoyed this video. Give this a like in case you did. And if you haven't yet, feel free to subscribe as well. I don't always publish that theory-heavy videos. Sometimes I simply do an altcoin analysis using the results of those theory-based videos. I publish videos regularly, so feel free to subscribe. We've also got a Telegram channel. We are almost 800 people over there. You can find us either by clicking the link in the video description or by searching for Bitcoin Strategy channel within the Telegram app. It would be great to see you become part of our community. Last but not least, if you've got any questions regarding this, or if you want me to backtest another strategy, feel free to comment this down below. Any comment helps the YouTube algorithm, and I read every single comment and try to reply to all of them. See you next time. Bye bye.